Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, editor of Smart Property Investment, back today with another episode of the Smart Property Investment Show. And I'm joined by our award winner for the Real Estate Business Innovation Awards, the Excellence Award winner, because he blew the judges' socks off at this recent awards event. I'm talking about the one and only Kev Tran. This is our first podcast together.
It's our first episode together.
I'm almost a bit nervous because I see you all the time on my Instagram with all of my colleagues. I think you've done potties with all of my colleagues except me. So now I'm a bit like, I don't even know what to expect.
Mate, this is the exciting one for me. I've been seeing you everywhere as well, and mate, it's exciting to be sitting down with the editor himself, and I appreciate the intro there as well.
Well, flattery is the easiest way to not get the hard gotcha questions. But no, jokes aside, we do have a really fantastic podcast today, and the theme of the podcast is it's the playbook behind Kev Tran. It is the playbook behind your investing methodology, how you support your clients, how you even do your own property investing. And we're going to be diving into 9 key lessons. But before we dive into that, I think it's reasonable to say that BAs, the buyer's agency space over the last few years has transferred pretty rapidly. I think it's pretty reasonable to say a lot of our listeners, every time they go on Instagram and there's different faces, different names every time, different ways of investing. Mate, what do you make of the space at the moment?
Yeah, so I guess I've been in the space for about 5-6 years now, and I've definitely seen it mature since I first started. Like even from within my own circle of friends and everything, I think most people have heard of what a buyer's agent is now, whereas 5 years ago it was pretty much unheard of. There's been a few shows, TV shows and everything as well. So what I make of it is definitely I see a lot of new entrants, which is totally normal. The barrier to entry is relatively low. I do believe there should be some more regulation, or at least some more education around the space, more compliance anyway. But there's also a lot of agents who have been doing this for 10 plus years as well. So really established people out there. So I definitely feel like the industry is maturing, which is always a good thing.
I think there's been a pretty natural pipeline from a lot of very sophisticated investors that have done a good job, that realize they just love the world of property and have come in. And I think it's reasonable to say, like you highlighted, a lot of people are very familiar with BAs now in a way that they weren't necessarily before. And the way that I compare it's kind of like the broking space, right? Way back when everyone would just go direct to bank, but just data this week showed that 77.6% of people now just go direct to a broker.
It's mental.
It's mental, and that's up about 10% on last year. So a lot of people, that's just becoming the norm. In the US, buyers agents are very normal, and I think it's the same over here. It's incredibly hard at the moment in the property market. We've seen in a lot of cities that listings have actually decreased, but competition, demand is increasing. You kind of need to partner with an expert to really, really break through. Otherwise, you're going to be with a throng of other people. Everyone that's buying at the moment for themselves, they tell me that they go into an open to inspect and there's just hundreds of people there. So working with an expert's quite useful.
Yeah, I guess the metric on our side there is, I remember when I was first starting off, maybe the first 3 years or so, I feel like it was 30 to 50% off market that we were doing. Now probably 80%. The last 12 months, 80% of our deals would be off market. So, talking about the trends of sales listings going down, it's like the only way you can actually get deals as well. So that's definitely a key consideration.
Why are the number of off-market deals increasing?
I think because of that competition, the trends long-term as Australia as a whole anyway, is that supply of established listings is going down anyway. So the trends of people holding onto the properties continue to be longer. So you have that. And just the I guess overall supply and demand of properties. A lot of people going for properties as well. So how do you stand out? You need to be proactive and call these agents many of them will transact off market. So moving forward, I see that trend just continuing.
Oh, 100%. I had a friend who went to an open to inspect the other day. There were about 70 other people there. To actually cut through is pretty challenging. Now we're going to get onto the playbook behind Kev Tran and the Kev Tran Group. Lesson 1: strategy before property. So, what's the key lesson after transacting in hundreds of millions of dollars of property, Kev?
So it's, I guess the way I always look at it is coming from the big picture into the micro details. And that's everything. That's strategy. That's the actual property selection. That's everything. But when it comes to strategy, we want to be defining the why before the what. And it sounds pretty simple, and people talk about strategy all the time, but I genuinely believe that you need to have a strong why with why you're getting into property investing in the first place, because on say like content and everything, you hear about all the amazing stories, but property is a long-term game, and it has a lot of obstacles and issues that come along with it. And without having that strong why to pull you back to remember why we're doing this in the first place, it can be very easy to be like, I'm a bit overwhelmed, I might sell this property or whatever it is. So start off with that. And when I talk to a lot of people that come on and work with us, they're like, I don't know what I want to achieve. I don't know that number of passive income, whatever it is. I'm like, it's totally okay to not know that. What you need to at least think for yourself is, what direction do you want to take? And I'll give you a few examples on how this differs for people. Some people don't actually want to achieve passive income that much. Yes, it's nice, but it's not like high priority for them. It might be actually to help them get into their primary residence. So they start investing, rent investing, whatever it is, while they're living at home, and that growth of the next 10 years might help them with a deposit, right? So that could be their goal. Some other people, they might be a bit later on in their journey, and to be completely transparent, we'll talk about this a bit more as well. To get passive income from property, it's not that simple.
Yep.
It takes a long time, right? So if someone's starting a bit later in life, maybe in the 50s, they only have 10 to 15 years left, their strategy is going to be very different. And to retire from property, passive income isn't the only thing. You can get a lot of profit from it. You could sell your properties and live off that. So mapping out what sort of direction is really key, because once you've done that, and let's say you kind of reverse engineer and you go, cool, I need X amount of properties and blah, blah, blah. You can then work out the purchase prices. You can also work out the minimum rental return that you need to keep going and all this stuff. And then later, it makes it a lot easier for you to then green light or red light properties, as opposed to getting stuck on the details. You just go back and go, hey, yep, cool. It fits in with my strategy. I can go ahead with this. So having that really clear in the beginning will kind of set the foundation, so to speak.
I think that's a super reasonable point of view. When I first started my property investing journey, and I never asked the why. Well, I knew kind of why I was doing it, and the why was probably too simplistic, which was, everyone else is making a bunch of money off property, therefore I'm going to buy a property in an area which I think is a really good area to be in, and therefore I get rich. If I look back to that point, so this was about probably five years ago, and my wife and I were like, Brisbane's so hot, like let's go into Brisbane. Like, this is a good suburb, let's buy into the good suburb in a hot market. And at that point, we got our bid at auction, but with the vows, what we were going up to, we would have been negatively geared at about $2,500 to $3,000 a month. And that was with the rent vesting strategy as we're in Sydney. So, and this was before the rent started going up $200-300 a week in Sydney, as we will remember a few years ago. And I look back on that now, thank God I was outbid at auction, because I'm doing the maths and I'm like, I would have been paying so much to maintain one property, because I thought it was it was a good suburb, but it was a suburb that's already had its growth. You're buying into this blue chip suburb that, maybe in 30 years, fantastic, but it would actually stop me in the meantime making an iteration of wins with smarter purchases, because I didn't map out that why. And my why was too simplistic of, everyone else gets rich off of property, so therefore I do it as well, which I think is probably quite a common thing. Is that what you see with a lot of your new clients?
Yeah, definitely. Like, obviously, I think if you living in Australia, you know that property is a very solid investment, and we have this probably unhealthy obsession a little bit too, right? But that's as far as many people go, and everyone's talking about it, and there is this fear of missing out, right? But when you get clear on it a bit further, and when you know how to get clear on it, and which we'll talk about in the next lesson, that helps a lot with making sure you make the right decisions for you. Yeah.
Do you think that a lot of your new clients that are coming through, you're a growing agency here. A lot of your younger clients coming through, do they have unrealistic expectations with horizons? One thing that you pointed out, and I think very fairly, which is property is a long game. And I think that was what a lot of people saw, when we were growing up. When I was growing up, the idea of a property investor is like, oh, hey, I've got an uncle that bought somewhere in Melbourne, and that's kind of what you expected of a property investor. Then there was this kind of 7-year window there where people were making these just like gargantuan returns. Then everyone starts getting on the train. And since then, I think a lot of people have now developed unrealistic expectations because they've gone from like hotspot city to hotspot city, and then suddenly, making 30% returns year on year, and then just compounding what the last few years has done seems to me to have made people's expectations probably a little bit. People expect that they're going to get returns quicker, but it is a long-term thing. Is that what you're seeing with a lot of your clients?
Well, with some people come on board, and I think especially like you said, the COVID boom, which we'll talk about one of the lessons in terms of market cycles and what I've seen over the last few years as well. Because even within the last 5 to 8 years, there's been some pretty drastic changes in like kind of like mini cycles, right? But there is this unrealistic expectation with some people because they say 20-30% growth, and they go, well, that's every year, right?
Yeah.
No, long term it's around 5 to 7.
Yep.
But to get to your these goals, it takes a bit of time as well. Because capital growth is one thing, but you're also talking about rental growth and all these things. But yeah, we can get into that for sure.
Now, I've been jumping around your lessons. So lesson 2 is know your starting point. And before anyone actually begins their property investing journey, they need to understand their position. Yeah,
absolutely. So there's a few things that to help you understand and map out that goal and the objective, right? Firstly, understand your financial position, because a lot of what you could possibly achieve is going to stem from that. Obviously, if you have the higher income, then you're going to have more options, right? If you've got limited, then you can work within that, but there might be more options than you thought. There's all these things. But what I definitely recommend is probably 3 core pillars to actually buy and scale property portfolios. The first is going to be the capital or the equity that you have, because you need that for the deposit. You put 10 or 20% down, whatever it is, maybe even 5% sometimes. The bank will lend you the rest, but you need some capital to start off with. So how much do you have in savings? Do you have access to a guarantor, parents? And or do you already have a property, whether it's your owner-occupier or another investment that you can draw equity from? So that understand what that number looks like, that's going to be really key, because that number also factors into your safety buffer as well, because you need to keep that aside as you scale the portfolio so you're not too stressed that you don't have any money left over. The second thing would be your borrowing capacity. And this is where I see a lot of people get it wrong. And when you work with an amazing mortgage broker, they can help you pre-plan as well, because they might tell you, yeah, you can borrow for this 600K property, but what's your total borrowing? Is it 2 mil? Is it 700K? What is it? Because that can help you pre-plan the next few deals as well. And the third one is cash flow. So all of these things will stem from your income at the end of the day, but how much excess cash flow do you have that you can, after your expenses per month, that you can save? Because that will help you determine how many properties you can hold negatively geared until they become neutral and all these things. So those 3 elements will be really good to clarify. And once you know that, then you can start going, all right, cool. What can I actually build?
Take us through that point that you raised about being able to plan, 2 or 3 properties ahead. How do you handhold your clients on that process? Maybe handhold's not the right way of putting it, but how do you? I suppose part of your job is you need to kind of coax this out of your clients, right? And you've got to get them thinking about it. How do you do that?
Yeah, so a lot of people will start off going, look, Kev, I maybe want to build a property portfolio, but look, it's my first one and I just want to make sure I get it right. I'm like, 100%. That's what we're going to focus on now, making sure that we get the best location, have the best strategy for this particular deal. But we also want you to do a little bit of pre-planning so that when you are ready for the next one, you haven't shot yourself in the foot because you've overextended on this first deal, whatever it is. For example, if you've got 1.1 mil in total borrowing, then maybe we can actually spread that across 2 properties if you wanted to, as opposed to buying one 800K property and now you're done for a little while. So that's what I mean by pre-planning. But what we do as well in part of this strategy component is we simultaneously also look at what properties or locations you can actually buy. And what I like to do is, for the first deal, it's what we call a foundation asset. We're buying a property that is in the strongest region or location that you can get. That'll give you that reassurance as well, as opposed to buying in a really small remote city or regional city. But yeah, it's kind of like all things encompassing at the same time.
And this ties into your third lesson, which is building the right plan. And obviously, we've touched on it earlier, which is not everyone necessarily wants not everyone wants the same thing. You got people out there that desperately want to get on the passive investment, or the passive income rather, train. But again, like you highlighted, if you're later in life, realistically, you're not going to be able to within 10 years, well, not necessarily within 10 years, build a $200,000 passive income, maybe a few quick wins that you can have an exit strategy, get out of later, and you can live off the capital on. Or, you might have the plan of maybe getting mortgage free, which is your ability and your way to save money. How do you go about building a solid long-term plan that actually works for your clients and their goals?
Yeah, so I guess like we were saying there, everyone kind of starts off at a different starting position, whether it's your financial position or even like your age or your investment horizon time frame, right? But I guess if we can give you some general thoughts here on building a property portfolio that'll give you those long-term goals. If you've got at least like 15, 20 years worth of investing, and you're starting off fresh, this is typically how we would do it. Our core philosophy is balancing capital growth with cash flow and building that sustainable property portfolio, something that you can comfortably do long term while still having a lifestyle. So normally we start off with a few residential properties, like maybe 3 to 5. Why? Because the barrier to entry is quite low. We can buy properties for like $450K to like $800K. Most people can do some of them, right? You buy a few of those first. The idea is as quickly and as efficiently as possible. So you minimize that buying window, so that they've got the most time to grow. Once you've done that, you just chill for a bit, let them grow. And then at some stage down the track, you can then leverage the equity there, either through consolidating, selling down an asset or two, or you could leverage the equity through refinancing and potentially buy a more income-driven asset like commercial. And for most people, this will kind of it's like 3 to 6 properties will kind of get them to that goal of maybe 100, 200K passive income.
Really?
Yeah, but the thing is, you got to remember, you probably need like 15 to 20 years.
Yes.
Right?
Yep.
Now, going back to individual circumstances, if someone has really high income and they are also really aggressive, like they go, they're really ambitious. I want
I like the word aggressive.
Yeah, let's say they're ambitious, but they need to be aggressive.
Yeah.
Right? So you want more passive income, shorter amount of time, you need to buy more assets.
Yeah. Have you seen you would have seen some pretty good success stories on that front.
Yeah, definitely.
Can you give us some?
Yeah. So one of my clients, we've helped buy 3 properties now in a couple of years. And he already came on board with one property himself. So he's in a position where I feel he's pretty comfortable in terms of a good residential base to explore commercial now. He's also working with a financial advisor who just happens to be my personal financial advisor. So like we're all aligned in terms of, hey, this is a great plan for you. And the next one is likely going to be commercial for him.
Already?
Yeah, he's sitting on a fair bit of equity there.
Yeah.
Borrowing, I think it's sitting a little bit tight. However, with commercial, and I'm not sure, we can just bounce around, I'm not sure if it's one of the lessons, but with commercial, there's something a lot of people don't realize is there's something called like a lease stock loan where let's say your personal borrowing is already tapped out at that point, but you can front up the 30% deposit, right? Many lenders will actually lend you the rest subject to that lease being quite strong. Right?
Yeah.
So that could get him into that commercial deal, and now it's going to really balance his portfolio, give him a lot of cash flow. Right? A couple of points to talk about that is the reason why some clients go to me, Kev, commercial sounds great. Can I just go commercial straight away? I've got $2 million lending. I've got some cash. Should I do it? Like personally, I wouldn't do it because commercial is great for that cash flow aspect. However, to get good quality assets, we're typically looking at like 1.3, 1.5 mil minimum.
Yes.
Because so much of the value is tied to the tenant itself, being an income-driven asset. So to get good quality tenants, you need a high purchase price.
Yes.
You also need 30% deposit. Sometimes I see 20, but typically a 30% deposit. So you need much more capital as well. But let's say you can do all that. The risk is also, even if you're buying a really good quality asset like industrial right now, and your tenant's in there for like a 5 or 10 year lease, real healthy. If something was to happen, even though they've got a long lease in place, if something was to happen to their business, they're not going to be paying you rent.
Yep.
You still need to find another tenant.
Yep.
And that could be 6 to 18 months.
So the actual the vacant, no, it's all right. The time it takes it to tenant it out is
Yeah,
longer.
but vacancy
Commercially,
period. Yeah. So with resi, it's like maybe 2 to 4 weeks if you're buying in the right area.
Oh,
Pretty quick.
100%. Yeah.
But yeah, commercial's way longer.
Yeah.
So typically, just summarize this: you start off with residential, lower entry points. You can buy multiple properties there. Use the capital growth from that to then leverage into commercial down the track. Now, residential, even though we balance the yields, they're not fantastic yields. So as long as you can comfortably hold the negative geared or cash flowed properties, that's the aim of the game in the early days.
Yeah. And talk to me about game plans in that.
Yeah, so I guess what I want to do with this podcast as well is like share the tools that we use as well. And some of them are free, some of them are paid. In terms of the strategy aspect, we use a tool called Game Plans. So shout out to the guys there. I'm not affiliated at all in terms of whatever. I just use them and I like them. I think mostly a lot of professionals use them, but I think as just a consumer, you can also sign up to it. So it's a paid account, but you get lifetime access. And effectively, it's a digital platform. You input your position that we talked about on there, and then it'll kind of guide you on your borrowing would be, how much cash you have, the safety buffers you need, and you can kind of visually see your portfolio grow over time.
Yeah.
The strategies you still need to know yourself, but regardless, it's a tool that you could use.
So it's fantastic for realistic goal setting, because a lot of people, I can imagine it will go both ways. A lot of people are both too cautious and some are too ambitious, and it's probably a good way of finding the more realistic middle ground.
That's the thing. So it's not me saying to you, hey client, your big goals, squash them. It's more like hey, you can achieve that, but this is what you need to do to achieve that.
Yeah.
You need to buy a couple properties every year, blah blah blah, and the holiday that you put down is like $20K a year. You go to Europe and all that, probably shave it down to $10K, and they're like, I don't want to do that.
Yeah.
I still want to do my lifestyle and all that stuff. I'm like, well, you're cool, you can, and you can still build a portfolio, but your expectation from here needs to go down a little bit. That's all. And they're like, I can live with that.
Yeah. Have you seen a lot of investors? Well, I know one thing that you've mentioned a few times is that sustainable living and being able to ensure that people can be in it for the long game. Have you seen a lot of investors burn out?
Yeah, definitely. And I also had to put myself in check as well, because obviously as the business is doing well and obviously I'm getting growth in my portfolio, my financial advisor actually told me this, and he goes, Kev, watch out for lifestyle creep. I say it all the time, and it's when you make a bit more money and you start splurging a bit more.
Oh, I'm so bad with that. Yeah, right? I'm so bad with that. Yeah.
You get into a better rental or whatever it is, you upgrade the primary residence. You just keep that in check. And again, going back to the strategy and having that visual tool that we use, it makes it really clear. It's like, okay, cool. If I just stick to this disciplined lifestyle, I can still have my holidays and I can still have Uber Eats, but I don't have to go too crazy. I still need to save $3K per month to my offset. If I can do that over the next 15 years, man, I'll be laughing when I'm 55.
Yeah.
Whatever it is. So, that's always a good way to look at it.
Which is that long-term planning. One thing that might also be worthwhile for a lot of our listeners is on the SMSF front. So can you take us through that?
Yeah, definitely. So the way that I like to work as well is from a property perspective, we can give you a lot of mapping and strategies and, matching your plan to markets and all these things. However, as we're going through this journey, if the conversations we're having will relate to another professional, we will lean on them. So I can get a rough gauge on your borrowing capacity based on your income and all that stuff. But let's refer to your mortgage broker for the credit and lending advice, for example. But if I ask you as well, hey, like, what's your super balance? They're like, oh, it's like $400K. I'm like, awesome. Have you guys considered buying something there? Yeah. I can give you some general information on how it works. You get 20% deposit. You can use $180K thereabouts of your balance to buy a $650K property, and you still got a whole bunch left over for other things, manage funds and keep bringing it there. And they're like, oh wow, I didn't know that. Cool. If you're interested, I'll connect you with an accountant.
Yes. Yep.
Or financial advisor, and they can give you some holistic advice around that. And if you want to go ahead,
that's where your job's done, right? You can't offer too much.
Yeah, exactly. I'm like, well, I'll give you, just because people aren't sure, know, and they're like, well, if I get an accountant, they want me to sign up. I'm like, I don't care if you do it or not, but if you want to, then, I'll give you general info, and then someone give you personalized advice. But yeah, that's something that people can explore, especially when we talked about that 3 to 5 residential properties, most people will get capped out at some stage, which is totally fine. People get fixated on buying in trust and all this stuff. It's okay to be capped out if you bought the right assets. But you can buy a property within your self-managed super fund. Doesn't impact your personal borrowing. It doesn't impact your household cash flow, your budget. It's just like an extra property that you can buy. And for most people, you can still buy a property there and still have money left over in shares. Yeah. You're not putting all your eggs in property, for example. So I think it's a great idea for most people to explore at least.
Yeah, I went for the hyper aggressive super fund, and I checked it. I checked it last year. It's oh my gosh, that's lower than I thought. Anyway, that's just my own. Those are my own tears. Went a bit too aggressive with that, but we're still on lesson 3. We've still got 6 more lessons to go. But I do have a question because we're talking about building out your game, your personal game plan, and your goals. Let's go back to when Kev started his property investing journey. What were your goals? What were some of the challenges you had? I mean, everyone makes mistakes, right? What were some of the mistakes that you made? Yeah, man.
I'll tell this all the time, which is why it's important to have that strategy. 2016, so I was working in the casino industry, a lifetime ago. I think I was 25, 26 then.
Whereabouts?
At the Star.
You were at the Star?
Yeah.
Swear, that's all I recognised you. Yeah.
So I was there, saved up 60K, and I was like, man, what do I do? Everyone goes, property. I'm like, all right, cool. And you remember like 2016, Sydney, Melbourne having their boom?
Yeah.
Right, so I was like, I need to get in, but I can't really buy anything for 60K. And family friends said, hey, why don't you buy this off-the-plan townhouse in Melbourne? It's like a house.
Yeah, right. Okay, so you went straight into like the reinvesting kind of...
Yeah. Yep. But bought brand new, which was the first mistake.
Yep.
Townhouse, second mistake.
Yep.
Yeah. So they said it was going to be like a year and a half until it's built, and mate, by the time it settles, this is what they told me. It's going to be worth more. Happy days. Yeah. You only have to put 10% now, 60K. That's it. Or like it was like 45K or something like that. 3 years later, so delayed.
No. 3 years.
Yeah, came in at contract price. Which is, I guess, lucky because I've heard of horror stories where it comes in lower.
Yeah.
Right? No growth, and the boom had ended. So straight away, though, as soon as I put the 10% down, I was like, I feel like an investor now,
Yeah.
So I started listening to podcasts. I remember SPI back then, and actually probably SPI is where I learned about LMI, Lenders Mortgage Insurance. Yeah. And I was like, I could have bought an established property with the 60K that I had. Yeah. And in the 3 years that it was being built, I would have been, if I bought in like Bendigo or something, that would have gone up like 150K or something.
Man, that like 2016 period, I like Spring Farm areas around, like some of the new areas around Southwest Sydney, like I saw some people doubling over a few years. It was wild.
Yeah.
What could have been? I'm sorry. Yeah.
Thank you.
Yeah.
But yeah, that's probably my main one. Buying new build, not using Lenders Mortgage Insurance. It's an amazing tool.
Yeah.
If used correctly. And it's something I always tell people as well, because I guess didn't have a strategy.
So at what point did you scale? Where'd you go next? When did you realize? When did it click that you wanted to be a BA?
So really, after I put that 10% down, I started listening to all these podcasts, and I was like, okay, I didn't know about LMI. I could have bought it, all that stuff. I kept saving because I also had pay increases during that time, and I feel like I was earning okay at 27. Anyway, I was able to save up another 10%. I bought in Ballarat for 385K.
Yep.
Back in 2018.
Yep.
Yeah. So when regional Vic was having their boom pre-COVID.
Right, and then the rest is history. So at what point did you become a BA?
So then I ended up buying 2 more properties since then.
Yep.
Right. So I had 3, and it was COVID. And I guess like most people, it was like, all right, cool. What am I going to do with life? Really? Yeah. I was like working at the start. Hospitality was the first industry to kind of get cut after the airlines. And I was like, well, if it's not now, it's never. So I just got my license and looked into how do I get educated, and I started working for other people first.
Now, I'll tell you what, also going into property in the middle of COVID was a gutsy move, hey?
Yeah.
It was a lot of people were really panicked.
Yeah, but I started working for another agency, buyer's agency, and they were doing really well. And I was like, what is... I knew why.
Yep.
But obviously, I think there was like a few months in 2020 like where there was a bit of uncertainty, but that quickly that quickly moved on.
100%.
And then, mate, it was like
people's discretionary
chaos.
spending, it dropped to almost zero. Like, it was during that period where, my wife and I started our journey, and we started our journey, and it was over the course of 2 years of a shutdown, and basically you're able to save up enough for a wedding and this and that, and probably because discretionary spending was dropped to zero, which is, to the point about building out your game plan and building out what you need to be successful, watching your spending, right? You do have the ability to scale really quickly when you do have a sustainable lifestyle. But you've highlighted a few growth areas and not so growth areas in terms of the townhouse in Melbourne, which takes us on to lesson 4, which is how to pick the right locations. And you've worked right across hundreds of locations in Australia. What's your secret sauce? How do you know which area to go to next?
So, thanks for reminding that we're only on lesson 3. So
yeah, that's my fault.
It's my fault too. Yeah. I rambled too much. So I'll try to go through. The idea behind this was not so much value as possible. Location selection. If you think about the core, I guess, concept that I've got here is big picture into the micro details. So big picture, same with locations and same with strategy is, let's look at, way I look at it is I look at regions first. So people straight away, they go to suburbs. What's the best suburb to buy in?
Yeah.
And when you look at a suburb in isolation, it might look really good. Supply's tight, demand's really strong, blah, blah, blah. But what if you take one step out and you go, how about that council area? What if that cluster of suburbs? And
then there's like 10,000 new homes being developed one LGA away
exactly.
or one postcode away.
Yeah, and then the nearby surrounding suburbs or high public housing and all these things, right? You gotta look at that from a big picture. So the way I do it is we go what we call macro to micro. So you look at local government areas or SA3. It's an ABS definition for a cluster of suburbs. So depending on the data set you can find, right? But that's the idea. And within that, 2 main things we look for. We look at your economic fundamentals, so diversity with different industries. Don't go anywhere that's like either employment or output is dominated by one industry. Could be agriculture, could be tourism, could be mining. It's too high risk. Something happens there, you're in a bit of hot water. So you look at that, make sure there's diversity. Unemployment rates. What are the trends there? Are you, again, at risk of people having a whole bunch of issues? Infrastructure pipeline, what's happening there? Because that'll give you some indication on future demand as well. Because people move there for big projects for work and all this stuff. They're the main ones that you look for from an economic perspective. If that all looks good, then we can move on to the number 2, which is the actual property market and the supply and demand.
Yeah.
And specifically what we're talking about there is what's the amount of stock on market now, inventory levels. So the way to think about that is it's normally, depending on where you set online, it's shown in months. So the idea is if there was no more supply coming on the market, based on the demand currently, how long would it take for all properties to sell out?
So you want as low as possible.
Yeah.
You want it tomorrow. Yeah.
Yeah, basically. So anything under like a 1 month supply is really, really tight. From a future supply point of view, you want to be looking at building approvals because that's going to give you an indication, okay, cool, how many houses have been approved to build, and likely most of them will come through.
It's wild. This one, it seems so basic in terms of the building approvals because obviously the lower building approvals that you've got when you're projecting into the future, the less stock that you're going to have, which all the other, it means that you're just going to have tighter supply for what you'd expect to be the same amount of demand. The amount of people that get this wrong when I speak to people around the barbecue is really astounding. And this isn't obviously investors. I think investors get this really quick. But, when I go to, the family barbie or like, you're sitting around a dinner table with friends and family, they're like, oh, it's good. There's so many new houses coming on board in the area. I think a lot of people think it means that the more people, there's going to be more vibrancy, more of an economy around it. And they've completely reframed it, whereas in reality, it's just 10,000 new places that have come online overnight. Now I brought out the idea of like Spring Farm and a lot of the places in Southwest Sydney before, but that's where I've also heard a lot of the horror stories outside of the boom several years. That's where I've heard so many of the horror stories of, suddenly. Once you factor in the $50,000 selling commission from the person that you bought it from. And they all come online at the same time, and then you go to vowel it, and it comes back at the same or less. And it's like, whoa. And this is before, defects are found. This is before, people start realizing, oh, hey, it's actually like a 30, 40-minute drive to the closest school or the closest train station because there's no amenities, there's no infrastructure. That's a bit of a rant, but it is amazing just how much people don't truly impact the building approvals and the supply aspect because they think, oh, more supply is going to be a more vibrant, cooler, more economically strong area. And that is just not the case.
Yeah, I 100% agree with everything you mentioned. There's also like this other aspect, a contrarian view to it as well, which is because so everything you mentioned, like I say, commissions hitting in the build cost, right, and everything like that, the purchase cost, because both materials and labor at all record level highs, and obviously government taxes and everything as well that make the purchase price so expensive. If you have a house in the same suburb but in like a really good patch that's away from where these new head states are, because you've got a few of them, like Melbourne, for example, you've got like Werribee, just like an example, where you've got like the eastern patch, which is all established with good schools and all that, and then you go to the west, maybe like 10 minutes or so, and you've got now like all these new estates. But what happens is, just something to note is all the new houses, they actually bring up the median for the area. Yeah, because of all the costs as well. Yeah. So it's just something to be conscious about. If you're still buying in a really good area, like a patch within that, it could be okay.
So your established place could be dragged up because the cost of the new builds is so high.
Yeah.
Wow.
Yeah.
Okay.
Even my most recent, this is just something,
wow.
It's obviously, you want to be very careful here because you're still buying an area with more supply coming on board.
Yeah.
But if you also marry this up with like, say, net migration, people moving into the area, and census do good data here, you can see if there actually is a lot of people moving in, so the demand's quite high. But my most recent purchase in Townsville, Bowley Plains, similar thing, where it's an established property, 2013 build, but just like maybe a few blocks away, there's some newer homes being built, and some selling for like $950.
Yeah, wow.
Yeah, and it's like it's bringing up the median quite a bit. So when it comes to vowels and stuff, it actually has helped.
So how do you marry that up with the concept of? I mean, I guess with your Melbourne purchase, or way back when, 10 years ago almost now, right?
Yeah.
Off the plan. How do you marry that up if you've got a lot of examples of off the plan stuff actually working?
So again, the asset type itself is really, really important.
Yeah.
Houses will do better than apartments because of the land component.
Yep.
And also strata and all that stuff. But what you want to be looking for is just areas where you still want a good amount of established supply already, and there's demand for that established supply. And there are some new builds happening, but it's not too much. So for give you an example, 3% of the total dwellings in an area being currently built is probably the benchmark where you'd consider that a bit high. So some areas are like 10%.
So we're not necessarily talking about areas where it's as far as the eye can see, where we're keeping to quite a conservative figure.
Yeah.
Yeah, okay.
Yeah, so like less than 3% generally is okay. And again, reason why, not just on a suburb level, but on like an LGA level, it's important because then, your suburb might be okay, but then right next door, it's all new build. So you want to be conscious too.
Yeah, for sure.
Yeah.
Vacancy rates.
Yeah, rental vacancy rates, anything under 3%. 3% is considered quite balanced, so that also is important. We'll look at the owner-occupier ratio. So generally, we like more owner-occupiers. It means that people like living there. We look at hold rates, so how long are people holding their property for? And ideally, longer term, you can see an increasing trend line. Sales days on market is a big one for demand. You can see how quickly properties sell for. And one that gets missed quite a bit is the socioeconomic index. So again, ABS do this called Index for Relative Socioeconomic Advantage and Disadvantage. Factors in education levels, incomes. So even within certain regions, you can find suburbs where the ERSAD, I'm not sure if I pronounce it right, but that's what I say, ERSAD level is quite high. It's score out of 10.
So what's that? ERSAD?
Index for Relative Socioeconomic Advantage and Disadvantage.
Okay, so that's what it was. Okay, that's quite quite long. Yeah, okay.
Yeah. So it's quite out of 10, and it factors in education, income, stuff like that.
And it goes, and you're at the micro level. You go street by street.
So that is on a suburb level.
Yeah.
With the ERSAD. But yeah, all these other things as well. We can Now, on a micro level, further to everything we mentioned, that's going to be like checking if your house is on like a public housing concentration as well.
Yeah.
And you can actually do this for free. I've got a video of this on my Instagram where I pinned it up front to show you step by step how to do it. You go to atlas.id.com.au and it works for most council areas in Australia. You can see on an SA1 level, which is I think between 200 to 800 population, how much public housing is around that area. So you can avoid the bad patches.
And you're also looking, my understanding, at what is nearby the house as well. You don't want to necessarily be on like a cemetery, or you don't want to necessarily be on a highway or something. Yeah,
definitely. So when it comes to the due diligence aspect, there's going to be making sure, we prefer away from main roads, noise concerns, all that stuff, safety, avoid flood zones, of course, bushfire, major power lines affect finance, but also...
affect finance?
Yeah.
Really?
Yeah, so...
how major are we talking?
High voltage power lines.
Like really, really big ones.
Yeah, energy substations as well.
Yeah.
So worth checking. And things like that you could consider other detractors, such as you mentioned cemeteries. Some people don't care. A lot of people do. Backing onto like a commercial precinct or like a car park. Yeah. So things like that. You just want to make sure, because even if you're okay with it, if you were to sell it or whatever, there might be 10 people interested, but then they go off.
100%. And it's funny because you mentioned like you might be okay with it. And I've got a pretty high threshold for some stuff. I live on a pretty main road at the moment. I grew up pretty close to the CBD, right? So I've got a pretty high threshold for things like that. But some of the data that comes out from, I think it's like your totalities and domains. I do reports quite frequently on this. And some of these little statistics of like living near a school or living near a main road or living near a bus stop or living next to a train station, all these things, it can reduce people's interest in your property by like 70, 80%. So just because you're cool with it doesn't really mean much unless you're looking to live in it for the next 30, 40 years. Potentially, you could be turning off 7, 8 out of 10 potential buyers for one characteristic that you might not even have factored in, and you paid market price for something that you actually shouldn't have.
Exactly, yeah.
So lesson 5, due diligence like a professional. I think that ties in very well. So once you found a property, what are the steps, Kev, that you take, and how can people not be an amateur? How can they be a pro in terms of their due diligence?
Yeah, so I guess what we talked about before in terms of the property data on a suburban micro level, that's all part of your due diligence as well. But further to that, what I find people make a lot of mistakes about, and I've had people work with me in the past, and they worked with other buyers agents as well who miss this, and it's a core thing that we do, which is unapproved structures are a big one. So,
man, you know what? I don't know why this keeps coming up over the last few weeks. Like sometimes it just keeps coming up. I found out that one of my friends lives in an unapproved granny flat.
Yeah.
And I'm like, but why are you doing this to yourself? Like, you've actually just spent hundreds of thousands of dollars for something that you can't sell and you have to tear down. Anyway, it's just one of those things. I've heard this so often over the last fortnight, but it's common, clearly.
It's common, yeah. And I can give you some recent examples that we've had. So one example was a client worked with us and they said, they worked with someone else and he bought a property for them. Right after settlement, they got a notice from council saying, mate, tear down your carport. It's not council approved.
Are you serious?
So he was like, what I went through all this and now it's going to cost me this time and money to get organized. So a kind of key thing here is when you're buying a property, depending on which state you're buying in, now Queensland's joined everywhere else where they provide I think it's called a Form 2, where you're supposed to be getting all these council approvals and everything as part of the contract.
Disclosures.
Yeah. But New South Wales already does it. Victoria does it as well. However, the vendor's got to include it in there. They prepare it themselves with their conveyancer. So if they don't add it in or they don't have it, you might not have council approvals for certain things. So often what I've experienced is I speak with agents and either they say, I don't know if the carport's approved. I don't know if the powered shed at the back's approved.
Half the time they just lie.
Yeah, all they say it is. It's all done, blah, blah, blah. Yeah, it's all good. So ask for the paperwork, right? You need to have that. And if they can't provide it and, it's a highly contested market, everything else is really sweet about the property, what you could do is you could potentially get something called title insurance.
Yeah.
And the idea behind this is if you've made all the reasonable checks on your behalf within the time frame that you've got to buy a property, but you can't confirm because the council needs to organise it. It might take 1 or 2 weeks. They also need the vendor to approve it. It's a lot of moving parts. You don't have time. You can get this title insurance and it can cover you for claims against the title later. So we're talking about unapproved structures. It could be, boundary issues, even potential things that don't get changed over properly during the conveyancing process, like water rates or whatever it is. So, yeah, it's a one-off fee, worthwhile for people to do sometimes. But on top of that, what I like to do as well is when you physically go through a property, this is never in the photos, but have a look at the gutters and the eaves. That can be quite costly to fix. And most of the time it's relating around moisture issues. So on top, in addition to that, when you go through the property, around the bathroom, just look at the surrounding walls to see if there's any damp.
Moisture
issues. And then also look at the condition of the shower itself. And you've got a few layers of kind of water protection. You've got the initial silicone grouting on top, and then underneath you've got the water membrane as well. Now on top, if you can say that it's been a poorly managed property and the grouting's all gone for a long time, likely it's going to have other issues too. Yeah. So these are just things that you can have a look before going and spending money on a building and pest inspection and all this stuff.
So you would do this before the building and pest?
Yeah. So you go through and just have a look. Have a look at that. Now, what else? Cracking. Yeah. Because they're not going to be in the photos or whatever. And then you can make a call whether or not this property is worth exploring further or not.
Yeah. I mean, the bathroom stuff, the moisture stuff is so important because it is just evidence of potentially long-term damp, long-term moisture that can really cause some damage to the hip pocket in the long run. Title insurance, is that something that you recommend that your customers always or your clients always get?
Yeah. Again, it's with insurance, it's always going to be a thing where it's up to the client and their discretion. We can't give that advice. We give them some general info and then, whether or not they want to do it or not.
You're always walking a minefield, aren't you?
No, well, exactly. It is. Whether
I would get it.
You recommend you do it or you don't. Someone can make a complaint against you a bit later, but we just provide all the info. It's similar to when you buy building insurance for the house. Yeah, you don't have to get the highest building cover. You don't have to get landlord insurance, but. Yeah,
man,
you might want to.
People I find out they're just living in unapproved stuff or just jimmy-rigging things at the other side. I'd be getting that's again not advice, but yeah.
So this is I'll be quick with this as well. We've been buying in Melbourne for a client, for our clients recently. We had this recent deal. Mitch, one of our buyers agents, absolute weapon in terms of due diligence. This property had a second dwelling at the back. Right, we thought it was just a shed at first. Went through it, and it was actually. It looked quite nice. It had sinks, a little bathroom, nice lighting and everything. The previous owner was using it as a little home business hair salon thing.
Oh,
yeah.
Random.
So their neighbours ratted them out, and they had an order to actually remove it. Yeah. Right. Or change it back to what it was approved for, which was a shed. Yeah. So then we inquired about it, and we were like, "So what's happening here?" Blah blah blah. And the council said. Actually, we inspected the property. We're okay to give the green light and remove the council order if you just turn off the plumbing, the main plumbing. You can have the sink in the little toilet, and you can keep the toilet there as well. But you can't obviously operate as a business. Yes, and you have to because they had the hair, the water basin for your hair. Yeah. That just has to be closed off, and that's good to go. Yeah. So that actually turned out to be a big win for us. It could have been a big liability, but 100%. Now our client has this extra space that could be used as an office or whatever. Which is pretty cool.
Yeah, that is good. And that is why you do your due diligence. And that was part 1 of my sit down with Kev Tran. Join us in just a few days when we release part 2 with Kev's top tips for property investing. That'll be coming up in just a few days.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.